presentation contains current opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone and welcome to the Compak YouTube update for September the 6th, 2023. I'm Mo Ansari, President of Compak Asset Management and host of Market Wrap, the daily broadcast that I do every day. And you can get that simply by going to the Apple Store and downloading all of this. You can get the daily update, the 1 hour broadcast that I do every day. You can get the weekly newsletters that I write. And obviously you can subscribe to this channel. Whenever I do an update, you will be notified of that. Let's get to the markets. We'll take a look at what the Fed is doing, the market is doing, the economy, and then technical analysis and the week ahead. Looking at the Fed, the expectation is by mid-2024, there will be interest rate cuts. The big question is, are they going to raise interest rates in November? They're not going to do it at the end of this month. The expectation is 90% or higher that no change in interest rates in September, but there's a 50% chance that we are going to get an interest rate increase in November. I think there's a lot of data that has to come out between now and then. I believe the Fed is done. I believe the economy is slowing. Inflation might not go down as quickly, especially with oil prices going up, but I believe the unemployment number will start to creep up. We saw the JOLTS report come out, and that was really the defensive manufacturing sector is still sort of just going along. It has come way down. It is still below the 50 mark, which shows a contraction in the economy as far as manufacturing is concerned. We did get the non-manufacturing ISM today, which was slightly stronger than expected, but I think that it will show as the unemployment number comes up, which I think it will, as we saw from the last unemployment number, it is starting, the unemployment went up from 3.6 to 3.8, even though it was just because more people are now starting to look for jobs. But the JOLTS report, which is, I think, the job openings, the number of job openings is coming down dramatically. And that is a good sign. And the quit rate is coming down dramatically, people who are quitting jobs, and the number of job openings is coming down also. And that means the job market is getting tighter. As that happens, I think people are going to start realizing, well, I might not want to spend as much. I want to keep my money with me. I might lose my job. And then when that happens, that's when people start closing their wallets. I've said that for the last year and a half. Since the beginning of 2022, when everybody was looking for a recession, I said no recession until unemployment starts to go up. Now we're starting to see some tightening in the job market, and if that continues to happen, I believe people are going to shut down spending, and if they shut down spending, that's 70% of the U.S. economy. That does not mean I'm expecting a dramatic recession. We don't have the structural problems we did have in 2008 or in 2000. I just think that we are going to see a slowdown in the economy, which will make the Fed pause and go back to the earlier chart that I was looking at. The Fed might even start lowering interest rates next year. As we go into an election, nobody wants a recession going into an election. I'm going to do a webinar next month on the 19th. Make sure you sign up for that. You can go to compak.com and /seminars, and you can sign up. They're all free, and you can do that. Looking at the technicals, market today just hovering right around the 50-day moving average. Last week I said we saw the wave count an ABC, and I think this is going to turn into an A, B, and we could see one more test of this 43.35 area, and we're somewhere around 44.5, 44.63 today. And I think that is going to continue. We're going to continue to go back and forth a little bit here until we get to the end of September. That is the way I'm looking at it right now. Support still at the 20-week moving average, which is at 43.67. We are right there, just hanging around, somewhere around about 100 points off of that. I think that's going to provide support, just like it did about 3 or 4 weeks ago when we came down to this 43.35 area where we saw about 4 weeks ago. Looking at the NASDAQ chart, very similar situation, ABC, ABC. That's, and I think this might hold, this entire move right here, all of this might become an ABC, and A, B, and C move to the downside. After 5 waves, as I said, we get an ABC correction or 5 waves to the downside. So far, just looks like an ABC sideways in this sort of vicinity, 13.1 to about 14.5, and that's where we are, just in this range. Until we break out one way or the other, we're just in a trading range right now. Support still 13,371. That is the 20-week moving average for the NASDAQ. And if we can get above this 14,650, that would be definitely a move to the upside. Again, one of the things that is getting people concerned is the interest rates. They've come back up towards this 4.33 high. That's the high that we made right here. Also, we came back up. We've been in this broad range of interest rate moves right here. And as long as we don't move dramatically above this 4.33 area, I think we're okay. But if rates start to go up a lot more from here, we could go all the way up to 4.9, 4.8, or 4.9, and that happens, that will put pressure on the market. I don't anticipate seeing that, especially if inflation, we do get the Manheim car index this week, and then we get the CPI next week. Depending how those come out, that'll dictate a lot if we do see a breakout in rates or not. But if we do see a breakout to the upside, that could put some more pressure on the stock market in the short term until we get to the first or second week of October. That's where we usually make the seasonal bottom, and that's from where we start moving up. Gold market stuck in this range, sort of going back and forth between 2,000 and 1,900. And just going back and forth. As long as we stay above 1924, we are okay. But if we break below that, then 1900 becomes support. The big question has been oil prices, which has moved up dramatically. That's something we have to watch. Week ahead, big number, CPI and PPI coming out next week for the month of August, and that'll tell us really what the Fed might or might not do. I don't think the Fed does anything in September, but we have a lot more data between the now and November when the Fed meeting will be after the September meeting, and I think the Fed will talk tough but still stay where they are. Again, if you want more detail, make sure you tune in to the daily podcast, download it to your iPhone. You can get the daily broadcast, or just make an appointment to stop by the offices or wherever you are. We can set up a Zoom meeting for you. Thank you again for joining me today for this YouTube update.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.